I am here with Rory Johnston, founder of Commodity Context. Rory, welcome.
Thanks so much for having me.
Today is such a great day to have you, Rory. You're a commodities expert. And today the price of oil has crashing well below $80. So my first question to you is, what the hell is going on?
Yeah, and I'm looking at Brent right now on my screen, and we're at just about $86, which is the lowest price since January, which is kind of surreal to think about. That like we've not only erased all of the kind of Ukraine stuff, we're now all the way back to the beginning of January, where it was this question of, everyone was thinking about shale, and like that was the big thing everyone was talking about. So I think, and we'll kind of get through this in totality, but I think today it's very clearly just a complete macro puke of risk assets across the board. Copper's following crude down. Crude basically looks like a perfectly inverted chart of DXY. I was saying to you earlier, that this idea that it's so often you see like the kind of daily responses about what was moving oil, and everyone's like, oh, it's the dollar, or oh, it was macro. And there's actually a lot of things that drive oil around at any given day, from the shape of the curve to what's happening in the product market to to this geopolitical news flow. All these things can affect it. So it always frustrates me that people default to oh, it's the dollar, but today it looks like it's the dollar. So I think that's the kind of frustrating thing. So I think and we'll kind of get into this kind of broader, the commodity context of oil and kind of what the backdrop is for all of this kind of macro tumult. But at the end of the day, that's what's driving us down. And even though oil always has to have a kind of fundamental clearance mechanism because it is a physical commodity, it is still typically sees price formation through financial instruments. So it's like the mother of all risk assets. So particularly in risk off moments like this, you're going to get really, really violent kind of pukes to the downside, which I think is exactly what we're seeing today.
That divergence between technical analysis, macro, what you're seeing on the chart, what anyone can really do just by looking at TradingView or something like that, and the actual physical world of oil, where millions of barrels of oil are being created and used and shipped every single day. That's a world that fascinates me because it's quite easy to you can look at the price of oil and you can do a 20-day moving average on it in the same way you could do it on the S&P 500 or on Bitcoin. But unlike Bitcoin, there are real barrels that are going there. And if let's say as in April 2020, the OPEC flooded the market with barrels of oil, and demand was destroyed, the oil price went negative. Like, the price of oil does not care about your moving averages.
100%, right? And at the end of the day, when you have big dislocations in the supply and demand balance of oil, I mean, and that was, April 2020 was the mother of all dislocations, and OPEC, helped and, it added, let's say, 1 million barrels extra. But I think the actual, prevailing supply demand balance in April of 2020 was something like negative. It was in surplus of like 9 million barrels a day, like something that we just never even seen historically, even close. Normally, in a normal oversupplied market, like the market that tanked prices from 2014 to 2016, that was kind of a consistent oversupply of something in the order of like 1.5 to 2 million barrels a day. That's normally the kinds of surpluses we're talking about. And same on the deficit side. It really doesn't, you're pretty range bound between, +2, -2 million barrels a day, which is kind of shocking when you think about how big the oil market is. Hundreds of millions of barrels, 100 million barrels a day every single day. Pretty shocking that you're only ever really off on the kind of balance by 1 or 2%. That's pretty impressive. But that's why, it's, little tiny bits of crude at the margin can really move prices, which is why, when it was 9 million barrels a day, completely, all bets were off. And what we've seen since then, basically since markets were completely glutted in early 2020 on the pandemic, then we went through this like prolonged period, one of the longer periods we've seen of sustained deficits, of sustained supply deficits in the market. And we went from an all-time high inventory position globally to basically back below what we would have considered normal inventories in that kind of 2010 to 2014 high inventory period. So, we went from really glutted to really tight in the span of a year, which again was the fastest drawdown on record by a long shot. So that was the backdrop really that we had going into the beginning of this year. markets were tight, inventories were drawing, everyone was talking about shale and how it wasn't ramping up as quickly. I think that is still one of the most important structural stories. But that's what was driving us higher. We began the year, 70, $80, kept going higher. We were heading towards $100 even before Russia invaded Ukraine, and then that kind of completely blew up all expectations. And to your question, you were kind of asking earlier, like, is this speculation or is this fundamentals? I think it's very legitimate speculation about the fundamentals, which I think is like a Weasley cop-out answer, but it's
an accurate answer. Yeah. And is speculation about demand? In other words, what is the macro risk factor? So we're recording on Friday, September 23rd, on a day where stocks are selling off. It's 2 days after the FOMC meeting. Bond yields are rising again. Pretty much anything that's not the dollar is crashing. And is it crashing because of demand destruction? There's the demand side, there's the supply side. But yeah, how sensitive to a recession, let's say, is oil? If we have a deep recession, how bad do you think oil could be? And could you put that in the context of today's price action? Yeah.
Yeah, and I think that's what's kind of confusing, right? So to answer your flat question, I think it's this idea. It's definitely demand. Like the concern is demand, that we're going to have some kind of recession. We're going to have demand fall back even further. To put in the context, I was saying earlier we had that like protracted supply deficit for most of last year and into the beginning of this year. And then, Russia happened. We thought everything was going to blow up entirely. And then we actually didn't lose as many Russian barrels as we thought we were. And then China basically locked up its entire economy. So in a normal recession, we're kind of talking in the order of like flat growth in demand. But what we're seeing right now in China is like negative 2 to 3 million barrels a day of kind of demand loss. So we're in this funny moment where we do have this kind of general macro dourness, but at a moment where we're also kind of still fighting the pandemic. The pandemic is still always going to have these like much larger than usual effects on oil demand because of its effects on mobility. So I think that, right now, and I think the other thing that we've seen is like there's, three major, at least, kind of centers of very different kind of macro narratives going on. We have the US and I'm in Canada, so you have North America, which strong labor markets, kind of underlying inflationary pressure. You have Europe undergoing kind of an energy crisis, and then you have China killing its own economy in many ways, like kind of locking down consistently. And, I just released a piece yesterday on kind of, China's oil demand implosion. And if nothing changes and we don't see oil demand, bounce back considerably in the next month or two in China, we're on track right now for the first annual demand or oil demand contraction in China in like 20 to 30 years. Like, China doesn't see its oil demand shrink. That's just not how the market's used to it acting. And it's the same thing with copper, with anything else. But I think the fact that, that is a much bigger drain on the fundamental side right now than any of the FOMC stuff. But I think that, what you've seen is the physical weakness has taken away any of the kind of, catching bid, if you will, for when macro sells off. There's nothing below it because the market is, by my metrics, was oversupplied as of July, where we're building inventories on a global basis as of July by my numbers. So yeah, I still think, looking forward, I think there's a lot of, optimistic reasons to kind of think that crude is not going to stay this low. But that doesn't matter right now because, fundamentally crude will always clear in the spot market. And that's what we're seeing right now is it's clearing in the spot market, and it's clearing for lower and lower and lower prices.
Yeah. So you say right now the oil market is actually in surplus. More barrels are being creating every day than are being used, so that those excess barrels are going into production. That's including the Chinese demand destruction, including Russia not actually producing fewer barrels. It's like pretty much close because it's exporting to India and China, including the SPR, that's including everything. It's surplus right now.
That's by my numbers, yes. Now I think you will have people debate that, and this is what oil analysts do. We debate global supply-demand balances, ad infinitum. But and I think the important thing is for me, I always look at it like, does it make sense with the price action we're seeing? Does it make sense with the calendar spreads we're seeing? Because not only have flat prices collapsed, as of, earlier in the year in like, May and early June, we saw backwardation in the crude market at like exceptional record
Rory,
levels.
so let me just explain that. So you look at the prior data, but the data is always prior looking, because the data you get in September is going to be what actually was happening in August. So the sort of most instantaneous data is the actual prices, and backwardation is where front month prices, as like the price of oil, if you want to buy it in September or in August, is more expensive than in December or March of next year. So you have a downward sloping futures curve.
Exactly.
And that is, it actually, to the untrained eye, and I thought this for a very long time, that seems bearish. It's like, oh, the market is telling you that the price is going to go down, but that is actually a bullish sign. Downward sloping is bullish. Contango is bearish.
Exactly. And I think that it goes back to my point about how like the oil market always clears in the spot market, right? And basically the importance of the futures curve is the shape of it relative to the spot market and what kind of arbitrage opportunities it facilitates to clear the market as needed. So in a contango where the market, is quote forecasting that the price will go up, as you were saying to the untrained eye, what it's actually doing is it's discounting current barrels so that you can pay for inventory storage. And then you can basically lock in a profit by putting that barrel in storage, by buying it today and selling it down the curve. And you've basically, arbed yourself a profit without really much risk. On the flip side, in a backwardation, you're essentially creating an opportunity cost to holding inventory. It's saying like every barrel we need right now, like send to the market. And that's what
Sell
we
it
saw.
right now. Sell it now.
Exactly. And we're going to penalize you through an opportunity cost because theoretically you should be able to sell this barrel, buy it down the futures curve for a guaranteed profit, and it's the opposite. You don't have any costs. You just don't have to hold oil for that period of time. So I think the fact even that by the time we saw that exceptionally high backwardation, I think related to that, inventory draws had actually kind of slowed down. I think that was part of why the backwardation was getting so extreme. Even with that kind of opportunity cost, refiners and other commercial participants were like, no, we need this oil. Like, we need this oil inventory. We need it just in case something happens, particularly in a moment of worry of like a loss of Russian supply. And there's this idea in the academic literature called precautionary demand, which is basically this idea that you create demand now because you're worried you're not going to be able to.
You kind of have that in Europe with natural gas, right? The inventories are actually very high.
Exactly.
Yeah.
That's exactly what we're seeing right now.
Yeah. So oil backwardation, I'm just looking, again, this is the morning of September 23rd. So November WTI oil is 79, and then May 2023 oil is 75. So you still have, a few bucks of backwardation there. So what you said we were in hyper backwardation right when the war started. What are we seeing now in the backwardation? And is it bullish or bearish?
We are still backwardated. So I think the one thing, and I'll admit this, like my models are showing us an oversupply, but we're in backwardation. That's kind of weird. So like, how do you square that? I think one of the things you can square it by is like we still have an overall very, very low level of inventory. So there is still this kind of like, lingering just feeling of insecurity on the inventory side that people want more. So if they can, they're gonna try and get it back into inventory, which I think is probably what this is reflecting. But to what we're seeing even in the last couple of days, this week we've seen the prompt spread. So the difference between the first and second month in Brent drop back down from about $1.50 down to $1. There's the other bellwether that people often look at is the December versus it's basically the deck, the December 2022 versus the December 2023 spread. That's also falling off with this morning's rally or this morning's rout. So all of those signals are saying that like not only is the financial asset, the flat price falling apart, but perception of demand is also falling apart, and perception of like spot market balances. So I think that's the kind of thing that whether or not we are in outright oversupply right now, it is still debatable, even if my models are showing it is. But what we do know is that the physical market has fundamentally and materially deteriorated over the past like 2 months. That's undeniable.
Deteriorated how? In terms of the price going down? What do you mean?
In terms of all those calendar spreads. So in terms of the shape of the curve, it just flattened so considerably. Whereas before we could kind of say, like, even if you sold off, like, well, the sell-off, sure, but the curve is still super backwardated. We still have this like immense kind of undersupply in the market. Now I don't think you can be as sure of that. And I think when you look at it, there's a couple of different ways of thinking about the futures curve and the calendar spreads. One thing that I like to think about, and I wrote about this in a piece, is the idea of it as like a risk filter. And it's not perfect, but what you have seen before every single major oil price route, so in 2008, and 2014, and in 2020 during the pandemic, in the week to month before that price really just, the bottom completely fell out, the curve flipped into contango. And I think that's the kind of thing that you're not going to, it's unlikely that you're going to see an absolute kind of like, 80 to $40 drop in crude in a backwardated market, because you theoretically still have that fundamental bid underpinning on the other side. In a contango market, you don't have that. So that's why there's just much more of, I think, a drawdown potential in a contango market, which is why I think it's so important to watch. So like if we do see the curve on a couple different metrics, kind of like, 1 month, 3 month, 12 month, if those flip into contango, that's, I think, your kind of major warning sign. Now, there have been in that same period, there have been 2 false positives for that signal. So it's not a guarantee, but it's, I think it's one of those things, it's like a necessary, if not sufficient condition for a drawdown of that size.
Okay, so you're saying a crash in oil is definitely possible, but if it does happen, it's extremely likely that the futures curve for oil will flip into contango before it does that, if it were to crash. And we're not in contango yet, but we're much closer than we have been this year.
Exactly. 100%. That's exactly it.
Tell me about the Strategic Petroleum Reserve. The Biden administration, we started selling barrels of oil, releasing something like a million barrels a day, was it? When oil was like 110, 120 bucks. To what degree did that ease the supply in the market? So, now there's just a lot more oil. So, to what degree is that the reason why the oil price has gone down? And now that oil is well below $80, is the selling going to continue, or is the release going to continue, or might they even start buying oil, which I've seen some people talking about?
Yeah, so SPR has been a fun topic this year. I mean, to put into the historical context, the SPR doesn't normally play this large role ever. In the entirety of its existence, the largest drawdowns we saw were like 30, 40 million barrels. They were like very contained for, much more time bound. They never had this big an impact. So the impact this year has been extreme. At the point when the Biden administration decided to embark upon this release, it made a huge amount of sense. And I wrote a couple pieces about this, and it becomes very political very quickly because it's a policy choice. But my argument was essentially that not only should you sell prompt crude to kind of bring the front of the curve down, which is what was hitting consumers, which was hitting the global economy, but you should also immediately purchase for refill down the curve. So what you do is you basically directly hit both sides of the calendar spread. So you basically pull up the back of the curve by buying and pull down the front by
selling. And you make money for the government.
Now, exactly. And you literally arbitrage, right? So unfortunately, the structure and the kind of regulatory framework for the SPR didn't allow that immediately. There have actually been very optimistic moves that the DOE has taken to allow for more flexible purchases along that line. So I think there's a lot of promise there, but you haven't seen any of those repurchases yet. The other thing was that when the release started, we were in extremely undersupplied markets with, like you were saying, prices at 120. Yeah. The challenge with a very blunt and kind of fixed plan, like is very common for a government program like this, is that obviously the oil market has changed since that release started. And to your point, how much of this oil price collapse has been the SPR alone? Not all of it. I think that the other side is that, China's, demand loss is about twice as large as the additional supply we've gotten from the SPR. But combined, that was enough to pull the market from one that was reasonably undersupplied to one that was decently oversupplied. And I think a better SPR policy framework will be able to react to the reality and stop selling when, the curve is, moving as flat as it is. Or, you have seen musings. Last week, there was musings around whether or not the SPR would repurchase in the spot market if WTI fell below 80. And there was a source in the White House that was saying they're thinking about that. And then the DOE came out and denied it. And I think that even the White House and the DOE are working on slightly different scripts here, because given how bizarre and different and kind of, I'll call it cutting edge, the kind of SPR policy is, DOE is executing a policy that they're not used to executing. Whereas the White House is thinking about what's next in this kind of policy. So any kind of change to the policy, I would expect to come from White House leaks rather than official DOE spokespeople. But I think that's just one of these things. We're like right on the edge of what people are used to thinking about as acceptable or kind of possible like range of policy.
So I know we have very little historical precedent, but you said the SPR, it would be prudent to stop selling from the SPR. But what do you think is actually going to happen? At what point will we stop?
I wish they listened to me more, but I think beyond that, we've already seen that they've planned now to extend the duration of the sales into November. They were initially meant to end in October. So I think that the benefit, the good news for the market, if you're a bull, is that they haven't increased the overall size of the release. They're just spreading it out over a longer period of time. So I think that's the good news. The bad news is that if you were hoping for a kind of a sudden stop to the flow at the end of October, that no longer looks like it's going to happen. So how much longer will it go? I think it's going to. I would be shocked if the White House decided to embark upon a second tranche of like a large volume of new crude released rather than just extending this one. That would be surprising in the current market. That said, even though those SPR barrels are, I would say, pretty objectively looking at the market right now, not needed, going forward into the end of the year, there could be a situation where they're needed again, which is, I think, again, one of these reasons where like we should stop selling now so that we can sell potentially later. Because as of December 5th, you get that trigger on the EU embargo against Russian imports. You have all these other things happening at this stage. OPEC has basically added its barrels back. There's not much more coming there. So that's a moment where, you could actually have a tighter market again. Now, I think the real tightness is going to come whenever China, pulls back on its COVID zero policy disposition, which, as I wrote in my latest piece, doesn't seem likely. And I'm not particularly optimistic with some of the people that think it's going to be a sudden about face after the party Congress in October. That's the kind of the overall theme that I think a lot of people are hanging their hats on right now. And I think it seems more likely that any policy change like this is going to need to be heavily, clearly communicated, by which I mean kind of propagandized, before it actually happens, so that both the Chinese Communist Party and Xi Jinping himself can kind of massage the message in such a way that this is a prudent kind of change of the policy stance, that's really well considered, rather than an about face that kind of hints towards some kind of policy mistake. I think that's the worry, which is why I think that any movement we're going to see there, I think we're going to see well messaged beforehand. So I think we're going to know it's coming.
You mentioned three important geopolitical events that will affect the price of oil. The first is the EU's sanctions on Russia, which you said will go into effect. The second is OPEC, the organization of oil, petroleum exporting countries, and their decisions. So that impacts the supply. And then the third is China's no COVID policy, which would impact demand. Let's start with Europe. So when do those sanctions go into effect? They haven't been in effect already? I thought that they were.
So they have been ramping up gradually. And the one other thing just before we go into, because I think this is a great way to kind of walk through them, I'd also add in, just on a barrel basis, the U.S. shale outlook. But those four things together are normally, they're the four most important things right now in the oil market by a landslide. And normally we fight about, like, oil analysts fight about like 500,000 barrels a day here or there on our balances. Each of those variables is like multi-million barrels a day of kind of swing, which to the point we were saying earlier about how the volatility, I think, is fundamentally justified. It's because everyone's is like changing their models every other week because these moves are just so big. So with that out of the way, to the EU sanctions, what you have seen is a lot of the sanctions we had seen at the beginning was a self-sanctioning activity. I think it's easy to forget that, 4 months ago, 5 months ago, Western governments were adamant that they were not going to target Russian energy with sanctions. They were going to target the rest of the economy, but they were very, very purposeful. And they were actually, like, the White House was annoyed about this self-sanctioning activity. They were like, we didn't want oil hit, and y'all are, hitting oil regardless because you're afraid of blowback. Whether that was legal or, as like Shell learned early in the crisis, kind of a PR blowback when they bought that shipment of Russian crude. Regardless, a lot of that has been, that was a quick and kind of sudden hit. I do think a lot of those barrels that had been traveling to Europe have found their way to less publicly kind of transparent and less publicly visible actors. So you still have a lot of crude and a lot of products going to Europe. As a great example, there's actually a refinery that's like a major piece of kind of policy debate right now in southern Italy. It's the largest refinery in Italy. It's actually owned by Lukoil,
Russian company,
Russian company, a largest private company in Russia. It was hit by kind of the self-sanctioning activity. So all the banks, even though it wasn't explicitly listed as a sanctions kind of target, all the banks pulled back lines of credit. So the only way that the refinery could get oil was by taking crude directly from its parent company in Russia. So now, if you do cut off that lifeline of crude from Lukoil without any kind of subsequent offset to either ownership of the refinery or to the lines of credit, well, this refinery is going to close. And again, it's the largest refinery in Italy in the middle of still an ongoing refinery capacity crisis, which is happening on top of all of the crude oil crisis that we're talking about. So it's a really, really bad scenario. I think a great example of the kind of unintended consequences of this kind of these sanctions regimes in kind of an energy economy that's become as convoluted and kind of interconnected as Russia and Europe. So what we expect will happen on December 5th is, as of right now, it's supposed to be a pretty sudden stop, and then you're going to see some kind of rerouting, hopefully, for Russia to other buyers, predominantly kind of China and India. Now, this is where we get into this topic of the price cap debate, and Secretary Yellen in particular have been pushing for this idea of a price cap. My thinking on the price cap has evolved considerably over the past couple months. I actually proposed something very similar, kind of tongue-in-cheek, in like early March. Basically said, like, what if we all just got together and basically said, Russia can still sell crude, but give it to us for cheap, and we'll basically like flip the arbitrage value to Ukraine to defend itself. And that's actually, in some ways, actually what they're kind of proposing now. The challenge is that the way they're doing it, I do not think it's even meant to be that effective. I think Washington was always concerned about how hard the clampdown Europe was kind of embarking upon on Russian oil, and worried about the kind of price pullbacks, worried about the kind of contribution to inflationary pressure in the world we're facing. So I think there's this thought that, like, sure, there's always a dual stated purpose to the price cap. One was reducing Russian income, which is the one that I think everyone kind of pushes first and foremost as this kind of like, yeah, Moscow's bad, let's take their money away. It's very politically popular. On the other side, it's just this very pragmatic view that if we do this, that short circuits some of the very obvious kind of bottlenecking that will occur from this EU embargo. So you would still allow barrels to kind of be transit through. And I think that in public, the focus is always kind of being pressed on, stopping money from going to Moscow. Whereas I think behind closed doors, and I think, the subtext is much more, this is important so that we don't blow up the oil market in the interim. So I think there's going to be this open question as to whether it comes to effect, how effective it's going to be. It doesn't seem like it's going to be that effective, at least in its current kind of permutation. Recall that you have, Iranian exports that are always still getting around sanctions. and that's on blanket across the board bans. Very very
Venezuela
visible.
too.
Whereas
It's
with
very hard
Venezuela,
to oil. It doesn't have a tracker. It's not like you can't put like a tracker ID in it like you put it in it like in a dog, it's like it's just oil.
exactly. Exactly. And I think imagine doing that, but on top of needing to like track it, which is already hard enough, then you need to validate the accounting. That's absolutely
and
crazy.
I could go out to the Black Sea with my ship, and you could go out and I could put oil into your ship, and then suddenly it's not my oil, it's your oil.
Exactly. Ship transfers. There's, for a long time, there was blending. Yep. So as long as the barrel wasn't more than 50.1% Russian, it wasn't considered a Russian barrel.
They call it Latvian crude, right?
Latvian crude, exactly. Yeah. Which Latvian blend. And Latvia, as anyone really knows, is not a big crude producer. So that's, pretty surprising. So I think that's the challenge. I think I'm mulling a piece right now, kind of writing about how you could make the price cap more effective. And, spoiler, I think one of the things you could do is if you set up a state-run entity as a intermediary, you that it would be the only one that's legally allowed to purchase Russian crude, and then would act as a middleman to then off-sell that crude to other participants in Europe. That would be a way of at least, it would be obviously unpopular for a whole bunch of reasons, but at least you could short circuit that, structural flaw in the plan, which is, how are you possibly going to validate hundreds or thousands of these individual, already especially murky in the physical commodity space, transactions? So I think that's something you could do, but I think it goes back to this question: do they want it to be really effective, or do they want it to be kind of effective, and you kind of paper over some of the potential trouble that a really effective price cap could bring?
So Rory, I'm going to say my understanding of it, and correct me if I'm wrong. Okay.
Yeah.
When the war first started, the EU and the US imposed sanctions on Russia, and the Russian ruble tanked. The Russian stock market, if you're in the US, it just went from like a certain level to zero because it was not, you couldn't trade it. It was just like delisted. And it looked like the West had a lot of economic power, right? And the thing was, if Russia stops exporting natural gas and oil to the West, it will be because we, the West, the EU, Germany, the US, make that decision because we're the ones holding the cards. But is it accurate to say, Rory, that there have been no government sanctions on Russian energy from the West, and there have been self-sanctions where a bank doesn't want to look bad to its shareholders and to the investing public, so it will, by its own will, get out of Russia, but they weren't compelled to by law. So is it accurate to say, Rory, that to the degree that Russian crude, Russian natural gas has that flow has diminished going into Europe, it is because Russia made that decision? Russia was holding the cards, not the West. Is that accurate to say, or am I wrong?
I'd say half right. I think definitely on natural gas. That is 100% something that Moscow has been rationing back on its own, trying to build pressure. I think there's an open question of it's a very painful for Europe now. Obviously, we can all see the kind of guaranteed recession it's going to cause. But it, in the balance of scheme, taking away the acuteness of this winter, the export is more important to Russia than the import is to Europe, because Russia really, that was the best customer. It was a high value market. It was fairly captive. It was a huge amount of kind of income that had been built up for decades and decades, this industry. It was built up during the Cold War, things that were theoretically, the stakes were often much higher. Moscow very purposely did not mess with the gas flow because they knew that was a commercial kind of, golden goose for Moscow. When Putin kind of really flexed and used the energy weapon, it's very much a double-edged sword. It obviously has been painful for Europe, but now Europe has been, moved into overdrive on various energy transition kind of projects, on trying to source new LNG imports from a whole bunch of other areas. Generally, Russia Russia isn't sending that gas anywhere else. Russian gas production is also collapsing because they don't have any.
Okay, so we say energy, but natural gas and oil are completely different markets. Oil you can put on a tanker, you can ship it from Russia to the bottom tip of Argentina, and it's going to cost money to ship, but you can ship it. Whereas natural gas, it's a gas, and it has to flow in a specific pipeline that takes years to build. And you know Nord Stream 1 and then Nord Stream 2, and it's you can liquefy it and then regasify it and ship it on a ship, but that is extremely costly. And the reason it's costly is because it's dangerous. So you have to spend a lot of money to make sure that the ship doesn't blow up. Yeah,
exactly. Yes. And I mean, and there is this growing LNG trade. So like you are having more of a kind of an oceanic spot market kind of develop. But in terms of the scale, it's just nowhere near the same scale as the pipe gas, right? I mean, it's just because it's so much more physically kind of convenient to send through a pipeline. It's almost like a power line, right? It's just, you just shoot it through that, and that's just the easiest way to get it from point A to point B without all of the expensive kind of chemistry that's required for the LNG side. Now, on the oil side, you did see some countries in the kind of first month actually outright ban the import of
like which countries?
Crude. Most notably, United States, Canada, and the UK.
Countries that don't need it. The U.S.
Exactly. Now, the U.S. was actually importing not a lot of crude, but was importing a lot of what these kind of residual fuels, things like vacuum gas oil and these kind of what we call unfinished oil products. And that has actually had an interesting effect. The way this came into affect the market was that it actually reduced the effective kind of production and yield in North American refineries that had been taking that crude. You reduced the kind of yield of things like diesel, which obviously that was further to the crisis that we were facing. On top of oil and gas, we've also this the worst kind of refining crisis that I'm aware of in history.
Really?
Yeah. I mean, you went from normal crack spreads, which is the difference between a crack spread, or it's like a refining margin, the difference between a barrel of oil and the products that it
gasoline
yields. Normally exactly, gasoline, diesel, whatever. Normally that crack spread, and you can kind of blend it a couple different ways, but on a 3-2-1 basis, which is kind of some gasoline, some diesel, whatever, that's normally in the kind of $10 to $20 range. And it's generally pretty boring. Yeah. During the height of kind of, in through May and June, when the SPR was like, this is how I was going to fix this, that was at like $70, like 3.5 times what you would consider normal.
Yeah.
And that was one of these things that even as oil was really, really high, consumers were absolutely getting brutalized by these extremely, extremely high prices, which all at the same time was further exacerbated by a strong US dollar. Speaking as someone in Canada that additionally got the currency hit on top of that.
And so Rory, gasoline, which is refined from crude oil, that is one of the most key inputs to American inflation, particularly in the mind of the American consumer, because they fill up their car so often, whereas they only make a tuition bill or something, every quarter or something. But as the Biden administration, Rory, is very quick to remind us, isn't it true that the price of gas has been declining for like 90 days in a row? So isn't the crisis over?
Yeah. Well, I mean, this is one of these things, right? Is that the benefit of having a all-time high crack spread on top of a nearly all-time high oil price is that really anything is going to be lower than that. So, and what we had coming forward for the last 90 days is not only oil prices have been kind of tanking over that period, but the crack spread had it as well. Diesel and jet fuel have remained a bit higher, still, I would say, at crisis levels, whereas in Europe and Asia in particular, the implied gasoline crack spread actually dropped to negative levels. And that was because, again, people had been producing more gasoline to kind of chase into driving season, but also there was just a lot less driving going on. You've seen it. There's lower kind of miles driven in the United States. Obviously, China has been locking down hundreds of millions of people, and they have not been driving around either. This is, really, really hit the gasoline market much more than anything else. Whereas the diesel and jet fuel market still have some of the industrial uses that are supporting them, and I think still also is especially Russia tilted. And And on top of that, you have this additional worry now going into winter that there's going to be a lot of so-called oil to or gas to oil switching in Europe, where people are, if they can, they're going to run a diesel generator rather than, heat their home with gas or whatever, which is going to most of those generators run on middle distillates like diesel, gas oil, and jet fuel.
Yeah, so under normal times, crude oil is rarely used to produce electricity. It's mostly natural gas or coal or renewables like wind and solar or nuclear. But this would be a switching. It's sort of a crisis time. It's like, we'll burn whatever we have. We'll burn the wood. Let's cut, saw off a leg of a chair to keep ourselves warm. And that's why you're also seeing a huge sort of bull market in coal as well, right?
Yeah, and my good friend Mason Hamilton actually posted a chart on Twitter the other day that it was just shocking to see that. So all energy at the end of the day can effectively be converted to a heat content, right? How much energy physically do you get out of it if you set it on fire? Normally, coal is at the very, very bottom of that kind of pyramid, which is it's reasonably energy or low energy density in the scheme of things, and definitely cheap on a kind of a relative basis. So when this chart I was talking about showed that on an energy equivalent basis, coal out of Newcastle, Australia, is now more richly priced on an energy equivalence basis than crude oil, which normally trades at something like 4 or 5 times the relative energy content value. So you have seen this just absolutely, all of the traditional relationships have gone completely out the window. On a crude oil basis, I think natural gas in Europe hits something like $300+ a barrel. If you're pricing it on an energy equivalent basis. So that's why it becomes so obviously very attractive if you have a choice of either putting natural gas into your facility or running it on diesel. Well, right now, diesel's much cheaper. Even though diesel is probably the most expensive part of the oil complex, it's still cheaper than gas.
Wow. And I also heard that there are 2 types of coal, metallurgical coal used to make steel, industrial production, and then thermal coal used to heat your home and generate electricity. Normally, metallurgical coal trades at a huge premium. It's much more pure type of coal, whereas thermal coal is much more impure. But because the economy is slowing so much, the demand for metallurgical coal is down, and the demand for thermal coal for electricity is up so much. I actually think thermal coal, I don't know if this is true, but correct me if I'm wrong, thermal coal is more expensive than metallurgical coal, which is crazy.
I didn't see that number, but it actually makes complete sense because, and normally we're talking at like $50 thermal coal and like $150 metallurgical coal. Like that would be a kind of
I heard it from
spread.
Doomberg, so
I think it's trustworthy. I think that's
know what they're
right
talking
now.
about. Yeah,
exactly. And I think that and it makes sense because, again, obviously there's a huge demand for anything that can produce electricity. And right now, given what's happened in China broadly in the kind of lockdown economy, but specifically to the real estate sector, not a huge demand for steel right now. So I think that's the other thing is like all of these traditional relationships have all gone completely out the window. I mean, more happens. I was saying this to someone the other day. More happens in a week right now than used to happen in like an entire year back before when I was at Scotiabank covering oil. Like you had so much more time to really analyze and obsess about little details about these kind of like reasonably niche topics. Now it's like every major line item in your supply-demand balance is basically blown up. And you need to try and figure out how to like put the pieces back together. So it's a truly, truly bizarre market. Oh, you're trying to piece together the nuance of oil and coal and what's happening with Fed policy and the dollar and everything else. Like there's no way right now. So I think everyone is, I think it adds fundamental kind of credence to the level of volatility at the very least.
You just said it was very volatile. And that triggered something in me. Yes, it's very volatile, but also liquidity is extremely poor. I've talked to a lot of oil traders, a lot of oil options traders saying, I've been in this business 20 years. I've never seen liquidity this poor. No one wants to buy or sell oil futures, oil options. Why is that the case? Do you have any insight into that?
I think when you look at it, what we've seen is this really started to happen at the beginning of the year around the point of the Russian invasion. And when you saw that initial, that initial level of volatility was truly crazy. You jumped up as almost as high. I think on an intraday basis, you almost hit that kind of 2008 high on a nominal basis for Brent, like $140 or something like that. And that was all happening very, very quickly. This volatility, particularly with everything else that was going on in the market, really ratcheted up margin requirements. And generally, it just became less and less affordable for these companies to express a view through these futures and options. And if they were expressing a view, much less able to lever that view up. So even if you could, I mean, I need to do more research on this, so I don't know the exact specifics, but you could have a scenario where you still have the exact same participants in the market, but they have less kind of effective powder to use because they have less effective leverage that they have access to. I think that's really part of what's driving this. And it's definitely right that the open interest in all crude contracts is down immensely. And it is one of these crazy things that, in some ways, you always hear that like volatility is a trader's friend. But at the other side, you need to be able to afford the positions and need to be able to actually purchase them. I think that's the kind of side that's really suffering right now.
Yeah. So just on that margin requirement, so a trading house had $300 million worth of cash to play with. Back in the day, they might be able to get exposure to $1 billion worth of crude exposure, but now they can only get exposure to $600 million worth of crude. So there's just much,
or less, right? I think it's like, and again, I don't have a good read on the exact tactical side of it, but I think it is like considerably down, and I think that's just visible in the kind of draining. And it's not just on the kind of speculative side. It's not just the traders; it's the commercial side as well. Like oil companies are reducing their exposure to the market.
Would they be hedging?
It's really expensive.
They would be reducing their hedges at the time that they'd arguably need it the most.
Exactly, right? Or particularly at a moment where it's like if you short crude at over $100, well, that's a great position for your company to be in, but it's also really expensive to maintain that short.
Yeah.
And I think that's part of this challenge is
also the borrowing cost went up as well. Like I've never traded oil futures, but just like from shorting stocks, it can be what you're paying 1% borrow or you're paying 600% borrow. So
and and again, I think that's a section that I just don't have the same kind of tactical side in, so I don't know the exact number, but I do know it's just become more expensive generally to kind of operate in these trades. And what you've also seen, you've seen similar things in European gas and power markets, where we've reached the stage where the kind of people just kind of say, the classic refrain is it's just a number. Like the price is just a number now. Like there's not much information in
Rory,
it.
what is going on? Those charts of German, French electricity euro per megawatt hour, whereas it goes from 100 euros to 1,000 euros. It's come down a little bit. What is going on there? How can an economy still work if power prices are going up that much? I know that they are forward prices, so they're not spot prices, the most ridiculous things, but explain what went on there, because those charts they amazed me, but they also confused me. I didn't really understand them, to be honest.
And again, full disclosure, I've spent so much time looking at crude that I haven't had a lot of time looking at the kind of gas and power markets. But I think it's something similar. Like it just becomes a one-directional trade, and no one has the kind of wherewithal to kind of stand in front of it. So I think to your point, like, is it viable for the economy? No, I don't think so. I think I think that's why we've seen governments embark upon kind of what we would have said, like historically all-time high kind of rescue packages if we didn't just come out of COVID. But like we're having like a second round of historic all-time large kind of rescue packages, locking consumer rates. And we just have this in the UK. And you're seeing it's kind of a bunch of other countries that you're moving the kind of burden from consumers to the government. And I think in a similar way where it makes sense from like a COVID policy lens, where it's like, what is worse for the government or the overall economy? Is it an expansion of the debt, or even in a kind of an environment of rising rates, or is it losing the entirety of your kind of entrepreneurial class? I think losing the entirety of small business is actually a bigger problem for an economy. So that's why I do think it makes sense to stand in front of it. Now you can quibble about, the best way to structure the policy, but I think it's, don't haggle over the price of the hose when your neighbor's house is on fire, right? Like I think we're very much in that environment right now. So I have tremendous sympathy for European policymakers in this environment because there really are no good options. The best option would have been to not build up, 10 years ago, 20 years ago, not build up an overwhelming dependence on Russian gas. But that ship has sailed, and now it's kind of like, okay, well, now your emergency trying to, ameliorate, soften some of the sharp edges of the situation we find ourselves. The one thing that just bothers me, and I would say you've seen, and you can see that European policymakers are now like this, like throw anything at the wall and see what sticks kind of face of policy formation. And you see every once in a while, you'll see like, oh, and we're considering capping, like, okay, we're going to consider capping Russian oil prices or Russian gas prices. Oh, maybe we're going to consider capping all natural gas import prices. I'm like, well, see, there you've gone well beyond what could even possibly be considered reasonable, because that's just how you get no gas.
Yeah, and especially
I think it's
messing with the production of American too, and Qatar and allies.
Yeah, I mean, at that stage, you just probably wouldn't get any gas. It would just go back to Europe, or sorry, just go back to Asia, because the part of the reason the prices have gone so high is that Europe has effectively needed to outbid Asia for these LNG cargoes.
So, Rory, help me understand this. So there are natural gas companies that are producing natural gas at maybe $2 per million BTU, or sometimes $3 per million BTU. Henry Hub, where they can sell out in the futures market, something like $7 or $8 BTU. It was higher. And then you see prices of TTF, Dutch natural gas, which I know are priced in slightly different things. But there was one time I did the conversion, and it was priced at about $60. So you can make natural gas in the U.S. at $3. You could sell it in Europe for $60. Yes, you have to sell it to a liquefaction plant, something like Cheniere. They're going to liquefy it. They're going to make a bunch of money too. But yeah, just how is it that the spread is so wide there?
That's exactly right. And the reason for it is kind of what you were saying earlier, that oil and gas are very different markets, in that oil is very much a globalized market, particularly over the last kind of 30, 40 years, whereas natural gas, up until very, very recently, was almost an entirely balkanized market. You had a European market, you had a North American market, you had an Asian market, etc.
No water.
That's
no water.
Starting.
Can't do water.
Exactly. No, right? And I think that's, it's really kind of hard to build a pipeline across the ocean. That's, I think, where we draw the line on kind of physical project viability. Yeah. So we've started inching towards a more globalized system because of the large build out of LNG kind of liquefaction capacity. The largest historically has always been Qatar, but US has now kind of stepped into that kind of leading role because of just a massive build out in capacity there. Australia as well. So what we're seeing right now, and in many ways, Henry Hub prices have been ratcheted higher by what we're seeing in Europe. And the reason that's happening is that you're basically maxing out LNG kind of export capacity. That in a normal environment, I talked about this honestly a year ago, where normally you would think about LNG, because when they were first being proposed, a lot of people said, well, doesn't this expose us to kind of globalized risks to the kind of gas mix that, could we import higher prices from Europe or Asia, which, what is happening right now. At the time, the thought was, no, not really. And the reason for that is that liquefaction is so relatively expensive and onerous that if prices in the US started to rise to such a high level where it became a problem, well, it wouldn't be economical to liquefy it and then ship it anymore. Yeah. But I think in those kind of environments, you're picturing, maybe, a $5 to $10 spread. But all of a sudden, that argument completely goes out the window, and the spread between them is $50 a million BTU. Yeah. Literally anything is profitable at that arbitrage. So what you've seen is even though prices are heading higher in North America, I called it the kind of pressure valve of LNG exports are broken. It's kind of broken and stuck open. So now you actually have this, in some ways, even worse environment where it's actually now the least price sensitive piece of the demand stack in North America. Because whereas, in North America, let's say prices go too high and then maybe people heat their houses slightly less, or
use
people
electricity.
Pull back on. Yeah, people pull back on, using natural gas to run crypto rigs, or, there are economic switch off valves. normally you'd assume that would actually be LNG would be reasonably low on that switching list, whereas now I think it's actually probably at the highest level and the kind of the most inflexible.
So tell me about this price cap. I really don't know much about it. How would it work? Are you banning the sale of crude oil above a certain level? What are the numbers like? And if the numbers are yet to be determined, let's just make it up and say it's oil's at 100 and something like that. Because I really I think hopefully a large part of the audience is like me, where they've heard about this but they really don't know the details. So yeah, just walk us through it.
Yeah, so I'm going to give you what I out the gate here, what I'm going to call my charitable interpretation. I've actually been on record as almost everyone in the sector hates.
Yeah, everyone who works in oil hates this. Yeah.
Yeah, everyone thinks it's stupid, and I'm an optimistic guy. I'm a charitable guy, and I also actually come from a policy analysis background. So what I appreciate about it is the creativity. I think that we've thought about sanctions in one way, which is kind of like a heavy hammer, like no more sales. Where you always had this challenge of there was an implicit trade-off that we can sanction Iran, but it might push up oil prices heading into the primaries or whatever, right? It was always going to be a challenge. Whereas with this, theoretically, what you're doing is you're allowing the same amount to flow. So you're having no main price impacts on the market while you're reducing the amount of money that's going back.
How is that possible? Explain that.
Yes. So the actual price level, now obviously everything is still completely loosey-goosey, but the price levels I've seen proposed are $40 to $60 a barrel for the price cap. $40 a barrel being the rough cost of production for Russian companies, and $60 a barrel being kind of this historical norm for Russia.
Okay, so the obvious problem is Russia produces it at $40. They sell it at 60. You want to cap it at 60, but even with the huge decline we're seeing today, it's still at 79. So how do you get from 79 to 60?
Exactly. So, and this is where we enter, let's say, our first challenge, which is allocation. Normally, in a market economy, how you decide on who gets what good is someone pays more for it. If you remove the ability for the market to, determine who gets the allocation of the crude, then you leave it up to other things. So either this is people under the table saying, sure, on the invoice it'll say 60, but there's actually $19 a barrel equivalent going to around the back, or whatever. That's the very obvious concern. The other concern is if you don't have that and you just have two people offering you $60 and you're Moscow, well, then you get to choose who gets it. And that will likely end up going towards kind of favored partners, people with, let's say a history of shady dealings with Moscow. So that's, I think, and then that kind of thing, it's an instant arbitrage for the commercial participant.
Sure.
And I think that's the challenge. That's the challenge. And to this prior point I was saying about how, it's hard enough to guarantee kind of compliance with Russia or Iranian sanctions where there's no barrels. Well, I can't imagine the bureaucracy that they'd need to create of forensic accountants that will kind of need to peer through all of these kind of, way bills and figure out. It's not really plausible, right? And I think that's the most obvious kind of criticism of it. On the flip side, there's a reason why this could in theory work. And the reason is that typically you don't want to shut in oil production. It has this tendency of damaging the reservoirs, reducing ultimate recovery, et cetera, et cetera. So even if you aren't making as much money as you could, but you're making more money than zero, it's worthwhile to continue producing. I think that's that kind of critical physical reality of the market that the price cap attempts to leverage. And it's basically Russia, Moscow, you can sell us your crude or you can shut it in the ground and it might never start up again, particularly not without our Western kind of oil field service company help.
Yep, and that's the thing. Once the oil well is going, you really don't want to stop it. And that's particularly true, I think, for shale.
Yeah, well, and particularly true for a lot of these conventional wells, because I mean, it's actually the opposite.
Okay.
So shale, you're actually creating artificial pressure, essentially. You're fracking it, you're kind of pushing down, and then you're kind of allowing it to come back up. Whereas in a conventional well, you're actually kind of boring down into a reservoir that has a lot of natural pressure built up in it. This is kind of like the Beverly Hillbillies, kind of the gusher, right? That's a bunch of natural gas and oil pressure that's built up. that's what you really don't want to shut in, because that's what you have a tendency of potentially kind of damaging. So that's, again, this is the physical reality for why it could work. Now, I had said a little earlier that if you set up an entity that acted as a middleman, that would be the only entity allowed in the EU, let's say, to purchase Russian barrels, and then it could turn around and sell those barrels to other participants in the market. Thus, you would guarantee that the government captures the arbitrage. You still allow a free flow of dollars, and then the government can, flip that arbitrage into energy subsidies or aid to Ukraine or any number of things at very expensive.
Rory, that sounds good. Two questions. What would stop it?
Yeah.
Let's say you're the good person. You're the good entity who's going to buy it at $60. I'm the bad oil trader who I do all the shady dealings. Why couldn't I just buy it at $70? Why couldn't China buy it at $70 and sort of push the price up? What is going to cause Russia to sell specifically to you?
So China definitely could, and I think it's not a perfect answer. My argument is that it's a better answer than is currently being proposed. Because the reason why the bad trader, if you will, in Europe, it would be much harder for him to buy a straight route kind of Iranian style sanctioned barrel than it would be to say, I'm going to buy this for 60, wink. Here's, $20 a barrel around the back. It's that kind of behavior that this idea could theoretically at least reduce the possibility of. That said, like you were saying, China could buy more. India could buy more. The argument for them to participate is they're actually getting something out of the deal, right? They're actually getting cheaper crude.
Yeah.
So that's a benefit for them. The big risk here, and this is, I think, something that I would have 3-4 months ago said was a very low likelihood, but now maybe a bit higher, which is maybe Russia, maybe Putin is just spiteful and says, okay, well, we're shutting in all the oil then, which is a possibility, right? I mean, that it wouldn't theoretically be much different than a really firmly enforced embargo, because that's the idea of kind of what that would do. But I do think that, the risk now that, Moscow engages in fairly extreme self-sabotaging behavior to spite enemies now seems like something that they might do, because they've done it with gas. So I think that is the concern now, that, Putin has said, we're not going to sell to anyone that, is enforcing a price cap. But they've already been selling for $30 discounts to India. So obviously there's some wiggle room in the middle as to where they'll accept it. The other argument would be if there was a firm price cap in Europe, that would actually even give Indian and Chinese buyers more leverage to extract even deeper discounts, even if they didn't go all the way down to, let's say, the $60 level. The argument in Washington's mind here is any less amount of money going is good. So it might not be a perfect kind of dragnet, but it puts pressure in the right places. But again, I think that argument kind of falls apart in the current permutation of the plan, which just seems impossible to enforce.
Thank you, Rory. For the final topic, I want to return to American shale. So American shale, there's shale oil and shale gas. The key feature of it is that it has a much faster decline curve, particularly for oil. So you constantly have to reinvest. So oil in particular can really devour capital. So you had a shale revolution, starting in, let's say, 2009, well, starting earlier, from 2009 to 2014, where production exploded higher. So it was good for the economy, but people did not make money. You made money if you sold a well to a shale, but so many companies went bankrupt, and there's kind of a speculative bubble, and Wall Street was just giving them all this cash, debt financing, equity financing. So now one would like to think that these shale oil companies, shale gas companies, they have learned their lesson. They've been humbled. They are not prioritizing production. They're prioritizing profitability. However, with that new mindset, they wouldn't rush to produce natural gas and oil with the same frenzy that you saw in 2013 and 2018. So yeah, I guess the key question is, how much is American shale going to add to the oil supply?
Yeah, so just to put that number of that unprofitability, I think, into perspective, it depends on which number you use and which kind of whether it's public or private or everything, but it's somewhere in between 300 billion and $500 billion of capital destroyed in the decade prior to COVID, which is just, I like to almost liken it as the kind of, blitz growth, kind of the Uber-esque blitz growth kind of pace. And I think, as a, good millennial, I, for the majority of my life, have dramatically benefited from, subsidized Uber rides and subsidized Uber Eat fares and everything else. And the world in total benefited from effectively subsidized oil production from the U.S. shale patch for a full decade. And what you're saying kind of now about like how much will they add, there's this weird reality where the U.S. will still be the single strongest source of supply growth in the world by a long shot, even under this kind of lessened growth regime. It's just growing at like half the pace that it was before. So just like in 2018, just for a reference point, when Brent was averaging for the year about $60, U.S. production growth on a total liquids basis grew by something like 2 million barrels a day year over year, versus total demand growth for the world of like 1.4, 1.5. This is why OPEC needed to cut during that period. U.S. shale growth was just insurmountable. It was wild. Now, this year, we're looking at maybe like 1.1 million barrels a day growth. Still huge. Like, I think that's the thing that I always try to communicate to people is like, U.S. shale is growing at nowhere near the pace it was. It's still growing faster than literally anyone else. And I think that's the crazy thing about it, right? So what's happened is that, there's this big talk about like the conversion of these oil and gas management teams to the religion of cash flow discipline. Yeah. So they're only going to grow profitable barrels. On top of that, the one thing that's challenging about this period is to really disentangle how much of that lessened growth pace is because of cash flow discipline, and how much of it is because of the rampant supply chain bottlenecks we've seen through the entire economy, and specifically to the U.S. shale patch. Now, to give it a couple examples, the sand that is used in fracking operations was in short supply. The pipes that were used in drilling and fracking operations were in short supply. Labor's in short supply. Everything's in short supply. On top of that, you also have so the oil industry itself had cut down to the bone for the last decade because of just terrible, terrible returns. Even more so, the oil field service companies had cut to the bone over that period of time. So there's also less general capacity for things like pressure pumping and everything else. So you have like this like multi-stage bottleneck on top of this already question of cash flow discipline. And if you're an oil field service company thinking, oil prices are high, should I invest more in capacity? Oh, no. All of my clients say that they're not going to grow any faster. Like Pioneer, the classic Scott Sheffield, sage, voice of the shale patch, basically said that it doesn't matter if it's $200 or $300 crude. They're not going to grow more than 5% this year. That's a really confusing message for oil field service companies.
Right, and let me just explain the economics. Pioneer is, if you have oil producing, you're printing money at $300, but oil field services, you only make money if they're building new stuff. If they're building new stuff,
Yeah, exactly. Well, that's exactly it, right? Yeah, the oilfield service companies don't actually own any of the production. But yeah, and Pioneer is printing money at $100, let alone $300.
All the companies are printing money. Yeah.
So like all of these companies are making so much money right now, but none of them are kind of investing in new production. Now, it's weird in some ways, right? Because if you look at it from like a classical kind of market, atomistic, competitive producers, they should all want to compete and grow market share and everything else. The thing where I think this changes is, and this is kind of a theory I've been running on, is that the ownership of these companies, very, very few people own just a single oil stock. They own a basket of companies. They own
XLE.
Now there's this...
An ETF.
Yeah, well, exactly, right? And it's a similar kind of argument that you use that people kind of employ. Like Matt Levine has employed this magnificently when it comes to index, the index fund owners and like the passive managers and things like, Pfizer during the pandemic. So, Pfizer shouldn't have wanted, wild excess profits because that would hurt the rest of the economy. Yeah. And the owners of Pfizer actually want the rest of the economy to do well as well. And I think the same thing's happening underlying in oil, where it's like, actually, no one grow because then it'll hurt everyone. And I think that's very much what we're seeing right now. So anyone, like fund managers particular, which are, they, talk about this a lot right now, is we want to see returns. We don't want to see growth.
Yeah.
Either pay down debt, buy back stock, or issue
They're
dividends.
seeing returns.
But like,
they're seeing returns.
No, absolutely. There's definitely returns. It's a fantastic time for the oil market. It's up in Canada, for example, not only are you seeing insane levels of like headline revenue, but you also have very, very low costs relative to history because you're not growing. And in Canada as a basis, it's not as true in the United States for the currency reason, but because of the strong US dollar, our costs are deflated here and our revenues are inflated. Yeah. So all of this that's happening is it's a boon time for anyone producing crude right now. So I think that's, the fact that we still can't get growth, that's the concern. Going forward, and I think we're, the one, just to close on this kind of like, what does the future hold? Like, is this just like a crappy market now for the next little while? And I think if you historically over the last 10 years, the majority of my career in this space, every time you had, the main times you had oil price collapses, it was because of too much supply. Whereas now what we're seeing is the price collapsing because you've seen demand across the world, particularly in China, fall off. So that kind of, demand line has fallen back below the supply line. But the supply line is still not growing very quickly. So if, when we finally do come out the other side of this macro haze, and particularly as China kind of moves on from its COVID zero policy, well, then demand is going to jump to the upside much faster than supply is going to be able to. Particularly because at that stage, the only source of fast supply in the world left will be the US shale patch, because OPEC has basically tapped itself out. That, I think, is the scenario of concern right now. And we were talking earlier about the SPR. That's a scenario where I think there could be more pressure to do a second round of SPR releases if you have a moment where like we're all of a sudden 3-4 million barrels a day undersupplied because all this demand has jumped back up, but supply hasn't moved. That's the kind of concern. The best case scenario we can have for oil market balance, in my mind, over the next year, 2 years, is a kind of a slow burn recessionary conditions that kind of holds demand flat-ish, or at least reduces demand or demand growth to such a level that supply can manage to keep up. I don't see supply growing by more than kind of 1.5 million barrels a day globally anytime soon. I think that's the challenge.
So we've talked about this extremely nuanced topic for over an hour. Now I have to ask you the very basic question. Do you think oil's going up? Do you think it's going down? Like what's your sort of price target and maybe volatility target? Like, do you think it's going to be choppy?
Yeah, so definitely choppy. That I can almost guarantee. I don't have official price targets, but what I will say is I do think that coming out, I think that we're probably going to be in reasonably meh conditions for the rest of the year. I'm going to say just broadly,
as in
we could
flat
go
to lower, flat to lower, like
flat to lower. I think we could have a scenario where we do. I mean, if we see large degrees of displaced Russian barrels after the December 5th deadline, that could be a trigger to the upside. But I think the biggest trigger we're still waiting for is China's reopening, which I still think at this stage looks like probably more of a Q1 23
But that could be super bullish, right?
Rather than a
that could be
Q4.
insanely bullish.
And that's the thing is I would say on a general disposition basis, I'm still reasonably bullish about crude oil. I just think that you have to be very, very cautious in this environment where China doesn't, 4 months ago, I was like, this is unsustainable. China can't keep locking it down its economy like this. But they kept going. And they are continuing to go. So even if we see a headline like yesterday that they're reopening certain areas, they haven't changed the policy disposition. They just cracked down and it got better, and they're going to crack down again. So I think until that changes, we're going to be in this kind of environment where you're going to always have these big downside risks. But on a kind of a call it, year to 3 year basis, I still remain very constructive to the upside on crude because of this fact that I still don't think that China's COVID zero policy is sustainable in the long run. And eventually, the global economy will find balance and begin growing again. We still have very, very low levels of international air travel, as a great example.
Yeah.
Eventually, that will begin to normalize. And that's where we start to get these big, huge demand boosts to the upside and I just don't see where that supply is going to come from. So I would say I'm a medium-term bull. I'm a near-term cautious. I'm near-term cautious. I won't even call myself a bear, but I think I'm near-term cautious.
Okay, great. And I guess I want to, final question, ask you about the economy. Looking at things like yield curve inversions or PMIs, there actually is a pretty clear pattern of, once the economic growth peaks and it starts to go down, it's likely going to go down more and more. And then you're either going to have a mid-cycle slowdown or you're going to have a recession. So recession is extremely likely in Europe. China already in recession. U.S. is... by some definitions, in a recession. I don't think U.S. is in a recession yet, because you got to look at a broad-based. You got to look at like incomes, production, investment. So,
I mean, unemployment's still so low, right? I mean, it's a weird recession in the United States if it is a recession. I think that's the other thing.
Yeah. There have been recessions that started with the unemployment rate at like less than 3%, but those are very rare. But I'm saying it's the rate of change is going down. The rate of change is, we're still growing, but the rate of change is going down. And in those environments, it seems like that's when oil gets hit really, really hard. So, like, what do you think about that?
I think that's exactly why I'm so cautious right now. I think that, anyone who says that oil can't drop below 70 or can't drop below 60, of course it can. It absolutely 100% can. I don't think it's going to stay there. But I think that at the end of the day, anyone that says oil can't do anything is going to get burned, just as a fundamental truth of this market. But at the end of the day, it is still a risk asset, and it's like, I think it's like the king of risk assets, that it's going to get punished in these kinds of environments. So I think that remains my concern. But I don't think changes unless in this kind of let's say we go into a deep depression. And to get out of it, the governments around the world basically spend trillions to completely overturn the energy economy. Yeah, that could have an impact on oil demand. But I think a normal recession like we're seeing right now, with kind of limited and kind of constrained fiscal kind of solutions to it, doesn't, to me, sound like we're going to change the fundamental path of oil demand growth coming out. So it's just a matter of time rather than, I think, a matter of scale.
Got it. Thanks, Rory. It's been a total pleasure having you on. People should check you out on Twitter at Rory_Johnston. That's with a T. And your writings, your work can be found at commoditycontext.com. Tell us a little bit about Commodity Context. When did you start it? Why do you start it? And if people check it out, what can they expect to find there?
Yeah, so I started Commodity Context as a free publication in June of 2021 and did that for a year. My background is as a commodity bank economist at Scotiabank here in Toronto. So my work is not the same kind of it's not strategy work. It's not equity research. My goal is to really look at the commodity as like a holistic economic kind of sector and kind of complex, and kind of bring together what we're seeing on the economic side, on the fundamental side. So I'm like what you'd call a barrel counter. So I like to build up these kind of big balance models to see what's making sense and how it kind of comes together. As of this past June, I've switched it over to being partially a paid platform now, and I'm publishing weekly. So I have a piece that should be coming out after we got off this call, on kind of a weekly kind of wrap up of what's happening in the oil market. This one's going to be pretty depressing, unfortunately. And on top of that, I also have a monthly report that goes out, which is the Global Oil Data Deck, which is kind of my version of something like the IEA's oil market report, kind of a monthly wrap up of data and gold balances. And also a monthly on North America that delves much more deeply into Canada, US, and North America and Mexico. And then most of my pieces are kind of thematic dives into whatever weird is going on in the market right now. And my last one yesterday was on China. So, 1 to 3 posts a week on a range of topics, trying to kind of bring a fundamental perspective and hopefully kind of transparent understanding to what I still think is, a fascinating commodity market in oil.
Brilliant. Well, thank you, Rory. So, but the final question I got to ask, this is just a quick one. How do you think about sentiment on Twitter? Because, I've a friend of mine, Jared Dillian, he's a sentiment analyst, and he thinks that people are just way too bullish. Like the price of it has gone down, and people, they're not humble about it. They're still saying oil is going to go to $300. Do you interpret, I know you're looking at the fundamentals, not the sentiment, but yeah, how do you sort of make the sense of oil Twitter?
This will probably get me in trouble with someone, but I think that, as a great example, so on Tuesday, I published my latest global oil data deck. By my numbers, it was the most oversupplied market in July since the beginning of the pandemic. That's a pretty bearish headline, right? And I think I got people kind of attacked me for it. They're like, "Oh, you're just parroting fake data or something like that," and that I think is just annoying. And I think it just belies a sense that I think a lot of people don't spend that many hours trying to build up kind of accounting models of this market. And that's fine, right? But I think it's also, I'm kind of in the camp, ironically and kind of counterintuitively, that thinks like bad data in many ways is good news, because if oil prices were collapsing and all of my data said things were cheery, yeah, that would be bad. Like that would mean that the data can only get worse from there, which means we have even more downside. I think the fact that July was the most oversupplied market since the beginning of COVID, I think is comforting in a way, because it's like, okay, well, that makes sense. That's why the oil market collapsed, and it's mostly China, and we're going to,
and that's also including the SPR too.
Yeah, exactly. So I think all that together, I think that I would say that as a general rule that oil Twitter remains very bullish. But I do think that it comes down to a question of timing. I think that my job is to interpret the data as it comes along. I don't put much effort or emotional kind of effort into holding a view long term. That's kind of my view.
Makes sense. Thank you. Well, Rory, thanks so much.
Thanks so much, Jack.
There is something that you need to be doing right now, and that is reading the Blockworks daily newsletter. For top market insights and the latest in crypto news, you have to subscribe to the Blockworks daily newsletter, and you can do so by clicking on the link in the description to this video or by visiting blockworks.co/newsletter.